Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee free transactions. Whether it's gaming, AI, or next gen dApps, Scale is here to power your future. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. GlobalStake is redefining staking with performance, security, and sustainability at its core. GlobalStake's self-owned, end-to-end bare metal infrastructure gives you unparalleled performance and risk management. Plus, with SOC 2 Type 2 and CCSS certifications, you get institutional grade protection you can count on. And it doesn't stop there. GlobalStake is carbon negative, meaning the more you stake, the better it is for the planet. With global reach, competitive pricing, and slashing insurance backed by the highest rated carriers, it's time to upgrade your staking game. Join the future of staking with GlobalStake, your trusted partner in institutional staking. Visit globalstake.io to experience its white glove service, superior economics, and best-in-class security. All right, welcome back to another episode of Forward Guidance, and joining me today is repeat guest Warren Pies of 314 Research. Warren, really good to have you on. It's been about 7 months since we last chatted, which was back when I was on the margin. Here we are on Forward Guidance, and yeah, really excited to chat with you today.
Yeah, likewise. I'm loving the new podcast. You're killing it, and excited to be with you.
Yeah, man, appreciate that a lot. Cool. Well, yeah, let's get right into things. We're in the new year, second week of January, and would love to just hear a bit about how you're thinking about this year. Maybe we can focus on the non-fiscal, non-Trump stuff first, and then obviously that's its own, can of worms that we can get into in a bit. Would just love to hear about how you think about the economy, global macro, monetary policy, et cetera, as it stands right now.
Yeah, I'm going to start like really big picture, and say our theme as we wrote our year ahead outlook was that we thought that 2025 was going to be a year where the theme was discovering neutral, or discovering what the real nature of the economy is post pandemic. And so nothing has changed that, even though we've had a lot of kind of policy and macro volatility, even just in the month since we wrote our year ahead outlook. Nothing's changed. I think this is all part of the process. And so what we mean by that is that, we had so many different cross currents and factors skewing the economy and kind of clouding the picture post pandemic. We think we're going to get some peak at what's normal here this year, to avoid burying the lead. And I know it's out of consensus right now. Our view is that by the time we get to the end of this year, there's going to be a consensus forming that neutral may have not changed coming out of the pandemic, that we actually could be, that maybe all this deficit spending didn't do anything, et cetera, et cetera. Now, I want to make it clear up front that I actually do think that the deficit spending and the things we've done have elevated the neutral rate somewhat. No one knows for sure. It's a totally unknowable thing. We have to kind of discover it on our own here, just like I was saying. But I just it's more of a remark on how sentiment swings so violently around that midpoint. And I think we're going through that right now. We're going through this period where, just 5 months ago or so in August, you had commentators coming on CNBC saying the Fed needed to do emergency rate cuts and 75 basis rate cuts at the September meeting. And now you're seeing major banks and commentators kind of revive the higher for longer playbook and ask, really, have we reached the end of the cutting cycle already? And so I see that sentiment swinging so much, and somewhere in there is the truth. And our view is that we're going to have a big swing down in sentiment for more cuts before this year's over. Getting a little closer to like zooming in, and I'll stop after this. Our view is that there's going to be another growth scare, and it's probably going to occur. Our best guess, and it is just kind of a educated guess, is into Q1, beginning Q2, somewhere in the first half of this year. We think the housing market is going to show some real signs of deterioration, probably some job losses within the residential construction segment of the market, and that will be the proximate cause of this growth scare and lead us down into this path of further cuts. And ultimately, at the end of the year, I think the Fed will cut the funds rate 3 or 4 times, 75, 100 basis points. And so that's the big picture view. And I'm happy to kind of dive in wherever you think it's interesting.
I feel like a really great jumping off point would be just what I feel like is this point of tension in markets and the economy right now, where we're seeing a lot of recent moves where, okay, we've seen the Fed pivot towards being more concerned about inflation at the last meeting, seeing risks, tilted to the upside. We're seeing a pretty large surge in bond yields. We're seeing, business optimism surge. We're seeing an increase in inflation expectations. It feels like there's a lot of these inflections that are moving higher, but then at the same time, there's some pretty valid concerns that we're seeing. I know like the housing market is a source of truth for you. So it feels like this interesting point of tension where also, the surge in long bond yields. The idea is that once you get up to these levels, that starts to have a slowing effect on the economy now. So I'd just be curious, like, how are you personally squaring the circles of this point of tension of what feels like a resurgent in economic activity, but also at the same time how that can lead to an actual slowdown 4 to 6 months later?
Well, we've number one, just a really basic answer to that question is we've looked at it in the 10-year has basically had an inverse relationship with the city economic surprise index with like a 3 month lead time. So, you would say like today's economic data, roughly speaking, is keying off of rates 3 months ago. And that's been kind of the way this whole cycle's worked, right? So that's one thing that one way I'm explaining it. I think that the slowdown happens and shows up within about 2 to 4 months, call it 3 months of the rate move. Now, how do I square it all? I think you kind of have to go back to the the September cut. And this has been a part of, I've been active on Twitter debating people about this and quoted in the New York Times about it. And I had Nick Timmeros bringing me into the conversation with like Jim Bianco. So this has been like a really, I'd say, central point of disagreement between myself and what is now consensus. And that's that I don't think the Fed made a mistake by cutting 50 basis points. I think that this sell off in bonds post cut was really about the market. There's really two phases. It was about the market first pricing out a recession. So if you go back to the September cut, we had the 10-year at like 3.6, 3.7. The 2-year was 140 basis points below the Fed funds rate before they cut. Major inversion for 10-year and 2-year versus the Fed funds rate. And when you go back and look at historic cut cycles, we've never seen that level of inversion. So that's an important signal. And the signal is that the bond market was telling the Fed, you're way too tight. And you're so tight that the amount of cuts that we're pricing in through this kind of inversion signals a recession. You only get this kind of cutting historically with recession. So that's why we say the bond market was pricing in recession. It had priced in all of the cuts that were included in the last SEP plus additional recessionary cuts. So when the Fed came out in September, cut 50 basis points, signaled through their SEP press conference that essentially they had the markets back and had the economies back. I think that started the unwind of that recession trade and sending us back to what I would consider as like fair value or the very lower bound of fair value on the 10-year. And we traded this in real time. So like what I would say is that, a lot of people say, oh, this is Monday morning quarterbacking. You're just fitting the narrative to the price action after the fact. And no, we were riding a bond overweight position from summertime into the first Fed meeting, and we went from overweight bonds to underweight bonds the day after the Fed cut rates. So we expected this sell-off in the 10-year. We thought that the 10-year had gotten too overvalued. And so that first phase took us to like 4.2, 4.3. That's where we think fair value is if you expect the Fed's near-term terminal rate to be somewhere between like 3 and 3 and a quarter, 3.5 even. And so then once we moved past that, that was phase two. Phase two was from 4.2 to where we are today, which is I think the bond market pricing out Fed cuts, moving up the near term terminal rate based off of the December, based off of the Trump election, number one, and then number two, the December SEP, which we'll get into this, I'm sure, is the Fed, without really any good reason, moved its reaction function in a hawkish way, which I think ultimately signaled to the market that they might anticipate policy from the new administration. So you could say this is a little bit of a political move out of the Fed members in that December SEP. So whatever the reasoning is, and we can get into it in my speculation, but whatever the reason is, the Fed signaled that there would be fewer cuts, and the market took that and ran with it. So stage two from like 4.3 up to 4.8 or where we are today was the Fed pricing, the market taking the Fed's word for it and taking cuts out of the market.
We'll definitely get into it all in a second on those updated SCPs because they're very interesting. But I do want to get into what you talked about at the beginning there, because hiding underneath that debate you had mentioned that you've been having is what you talked about at the start of the interview, which is this debate about where neutral is. Has it risen or has it not risen? So, I was just looking at the SOFR curve, and the terminal rate is like 4% now. So, it's funny, like the idea that the Fed hiking the federal funds rate can have an effect on the economy somehow seems to be out of consensus these days, which is quite funny. So I'm curious about your thoughts. You mentioned that it wasn't a mistake. So in your opinion, you believe that they were indeed restrictive and were still restrictive even after the 50 basis cut. It feels like, you also mentioned how we can't observe directly the neutral rate. We have to feel it. And, some might see the reaction of the bond market as starting to feel that neutral rate is higher, and that's why that terminal rate's at 4%. So how do you view those different perspectives about the 4% terminal, restrictiveness, and whether the Fed funds is even like an effective tool? Because that's become an open discussion these days.
First off, I think that 4% terminal is let's just take that let's start with that. If we're at a 4% terminal rate, what should we expect the 10-year to be? And like, let's just say that the 4% is where they're done, like literally done with this cycle, not just done for this year, but they're going to cut down to 4%. Then I think that we're in this total pause equilibrium. You would expect to see the 10-year at like 5.25, in my view, in my worldview, about 125 basis point spread. And you would see that it kind of move up in anticipation of the ending of the cut cycle, and kind of but that's where it would land. Now, one caveat to that, in some research we haven't published yet, though, is if you know that the cut cycle still goes, so what's the appropriate spread between the 10-year and the Fed funds rate? I just said like 125 basis points. And that's true if you look at like all of history, roughly speaking. But if you're in a cut cycle, if you know that the Fed's next move is a cut, then that spread drops to about 60 basis points in those historic periods. If you know that the Fed's next move is going to be a hike, then the spread between Fed funds and the 10-year is closer to 170 basis points. So the posture, this idea that you said that the short rate doesn't impact the economy, is like, to me, it doesn't line up with the data. There might be a 0.5 beta in the 10-year to the Fed funds rate, but there's still a beta. I still look at long rates as ultimately the current Fed policy, future Fed policy, and term premium. And that's it in a very simplified mental model of the world and how rates move. And so to me, that's 4% terminal rate, no cuts, nothing else. And we'd go up to 5.25. Now that pushes your mortgage rate, or let's just say we're going to stay at a 250 basis point spread on the mortgage rate. So we're at 7.5, 7.75 in that world with that terminal rate. My ultimate view, and this is why we say housing market is our source of truth, is that the housing market, and thus the economy, cannot handle that high of a mortgage rate. In fact, I don't think it can really handle a mortgage rate at 7%. And so that's how we kind of back into where is the Fed's terminal rate, where should the Fed move to, is because we're saying I talk to some housing analysts, and in private conversations, they'll say, I feel like I can see neutral in real time, because if you look close enough at these housing indicators in the home builders, you can see them shifting and changing their behavior patterns as that mortgage rate hits a certain equilibrium level and then bounces around it. And so to me, that's the best way, the most practical way to work backwards from um, what kind of rate the economy can handle. And so our line in the sand kind of is 7% and a 4%, 7% mortgage rates and a 4% terminal Fed funds rate, or implied by the SOFR curve, is not going to is still restrictive. You're going to slow the economy down. You're going to slow the housing market down. There will be layoffs in these cyclical areas of the economy, and eventually a recession if you hold policy there long enough. Now, there's a big debate on how long the economy could withstand rates there, but I think it would be a pretty rapid slowdown if the Fed actually signaled that's what they were doing. So that's my view, is like that ultimately right now, that what's going on in the SOFR curve, what's going on in the bond market, in the mortgage market, it's restrictive, and ultimately will necessitate or will bring forth this growth scare that we're predicting.
Nice. That's a solid answer to the trio of questions I threw at you there. So I appreciate that. Yeah, as you mentioned, we're in this realm of restrictiveness. It's started to have a continued impact on the cyclical sectors. You've done some work on the housing market, home builders, and inventory and that dynamic. I would love if you could just walk us through what you're seeing there and how that's going to be representative of this further deterioration of the labor market that you're seeing.
Yeah, I mean, again, everybody has to have a mental model of how recession begins and evolves, right? And so when we study history, we see cyclical areas that lead the economy deserve our focus, because by the time you get to broad-based job losses, the recession's on top of you already. So we focus the best cyclical job sliver in the economy is residential construction payrolls. That's our view. Usually leads recessions with about an 8 to 10% drawdown prior to the recession. That's on revised data, which muddies this picture a bit, but just like hang with me for a minute. 8 to 10% drawdown in residential construction payrolls precedes each modern recession in the United States. And so, and there's a huge multiplier effect in the housing market as well. If you go through a housing cycle, it's going to hit durable goods, it's going to hit all this other. So there's, I think, good reason to focus on this particular sliver of the data, even though residential construction payrolls, when you strip out trades, which is what we do because there's more data, is only about 1 million jobs total in a 150 million job economy, right? But and just as a side note, when you go through a recession, that's going to be the swing factor for when you lose jobs. So even though it's a small sliver of jobs, total construction jobs can be 20% plus of all the jobs lost in a recession on average, basically. Even though residential, non-residential is like 2 million jobs in the economy, you're still seeing like huge job losses there, which is the swing factor. It's not going to be government, healthcare, education. It's going to be these cyclical areas. So we focus there. That's where we focus. And we build a model. We basically model out the industry and say, okay, what drives the employment in these cyclical areas of the economy? What drives residential construction employment? Well, mostly it's units under construction and that backlog. And what drives that backlog is starts and time to complete a unit. So you take a single family home. How long does it take to complete that? It's usually a single family unit. It's taking like 7 months to complete. A multifamily unit takes about 21 months to complete. We also, a single family is more labor intensive. There are more jobs associated with the single family unit versus a multifamily unit. So we have to adjust this for labor intensity in our model. But the bottom line is, when we came through the pandemic, this is when I talk about getting a good look at the true nature of the economy. When we went through the pandemic, we saw the housing market was one of the strangest areas. So you're talking about inventories. We saw completed unsold inventory, which is a good indicator of the market's tightness overall. We saw completed unsold inventories hit like single digits of total inventory in the housing market. And this was like an all-time record low. It was just indicating like just an extremely tight market. Like there were no spec homes out there to buy. Everyone was trying to move, and everyone was taking the inventory as soon as it was available and then putting it in our contract. So these builders had a huge backlog. And then on top of that, we had supply chain issues, which blew out the time to complete. So, like I said, multifamily was a 21-month on average historic time to complete. Well, during the pandemic years, it blew out the 30 plus months. Single family blew out to like 12 months from 7 months or so historically. And so we had this huge backlog of work uh, that kept this industry moving despite the Fed getting tight and rates moving up. And this is why the housing market's been sort of resilient, the new construction at least. Well, entering in now to 2025, time to complete has normalized. Multifamily's gone from 30 back down below the historic average, like 20 months to complete a multifamily unit. And single family's basically back to the historic average of 7 months as well. So that backlog that kept units under construction elevated and thus employment elevated is gone. Um, and the other factor is big factor is inventories have normalized. Inventories have shot up to pre-pandemic levels. Um, if you go and look at what I would say the bellwether companies within this industry, the home building industry, like we looked at DR Horton's the largest builder in America. Their inventory situation is even more dire, And I'm not saying that the stock. Actually, I think the stock's actually an interesting spot here, but um, their inventory situation has spiked up. Their percentage of unsold completed inventory is up at like 40%, well above your national average, well above other builders. And what that tells me, because they're a leader in how they manage their inventory, they manage their inventory very aggressively. That means they're going to pull back on starts aggressively going forward. And I think that is just the very um, tip of the spear for what's happening in this home building cycle. And so all the things that held it kind of made it resilient in the years previous have dissipated. And now we're about to find out what this housing market and what these home builders can actually deal with, and how resilient to 7% plus mortgage rates is this new home market. And I think we're going to find out in the first half of this year that it can't handle them very well at all, and you're going to see slowdowns there um, in those major national builders that have kept this thing afloat. The last thing I say, not to go on and on, is we do a model where we take all this stuff and we predict where should employment be in the residential construction industry. And we're at like us we're at we keep making cycle highs. So this is a good, you know, this by our framework tells us we shouldn't start calling for recession or anything dramatic here. So we're still at cycle highs, but our model says that there are about 75,000 too many jobs in that sliver that we watch. So we're really, really on watch. If there's any further slowdown, I think you have to be on watch for layoffs or negative revisions to the data. It's going to be a sticky type of cycle because I think there is going to be labor hoarding. There is labor hoarding, but it's a precarious position.
This is still an emerging situation, but I'm curious about how you think about the economic impact of the LA fires on home building and construction payrolls. Because obviously, if we're going to see this idiosyncratic move of, a ton of construction for, like non-market reasons, natural disaster reasons, does that muddy the water with the signal that you might derive?
Yeah, I had some client questions on that actually this morning, and so it's on people's minds. I think the short answer is we don't know. Honestly, we can do our best to put some numbers around that, and that's that. The total cost of the fires right now are estimated to be 150 billion dollars. And I've seen some estimates that maybe and this is everything. This is municipal damage, cars, personal property, structures, everything, commercial, residential. What I've heard is like you could make a very conservative and probably low estimate that 10 billion is structures, and then out of that we don't know what's residential and non-residential, and so it takes like 4 to 4,000, let's say, workers to put $1 billion of construction in place in the economy. And so you can kind of work backwards and say, okay, it's going to draw some labor. It's going to require some labor. But there are questions about how portable the labor will be, whether we can import workers from one area of the country to another. So, and about the timing of how this rebuild could take 10 years, it could be spread out over a really long period of time. And so it's really difficult to know. It's something we're going to have to keep our eyes on. When you look at like CPI data, BLS surveys and stuff like that, they break it down by region. When you look at jobs and housing starts and things like that, they also break it down by region. And really, the driver of this current housing cycle has been the Sun Belt. So I think we're going to stay focused on the Sun Belt to try and keep some of that noise out. And most of these national builders, that's where they're really operating, is in the Sun Belt states, and so it wouldn't really be theoretically impacted directly by the situation in Los Angeles. So those are kind of my initial thoughts. But I think like everything, you have to have a framework and then like be very adaptable. Like
Yeah.
we're really not big on making huge predictions, and this is why, because you can have things come right out of left field and change your entire situation. But as of right now, I think I'm treating it more like a hurricane and something that's going to be. It's a horrible situation. Don't get me wrong. But it's for the data and for the economy. I think the effects are going to be spread out and be um, largely overshadowed by the macro trends.
Yeah, for sure. And you're not unaffected by natural disasters. I know you got affected by a hurricane this year, so you know what it feels like for sure. Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at scale.space/ecosystem and follow their journey on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. GlobalStake is redefining staking with performance, security, and sustainability at its core. GlobalStake's self-owned, end-to-end bare metal infrastructure gives you unparalleled performance and risk management. Plus, with SOC 2 Type 2 and CCSS certifications, you get institutional grade protection you can count on. And it doesn't stop there. GlobalStake is carbon negative, meaning the more you stake, the better it is for the planet. With global reach, competitive pricing, and slashing insurance backed by the highest rated carriers, it's time to upgrade your staking game. Join the future of staking with GlobalStake, your trusted partner in institutional staking. Visit globalstake.io to experience its white glove service, superior economics, and best-in-class security. Okay, so I want to talk about the economic forecast from the recent SEP, as you hinted about earlier. So, I just have it up here, but basically the Fed thinks the unemployment rate is going to be at 4.3 for the next 3 years. And they see that PC inflation, they revised it higher for 2025 from 2.1 to 2.5. So there's some very interesting insights to derive there. Maybe since we've been talking about the construction payroll situation, we can tee off with the labor side of the mandate and just any final thoughts there. So they're seeing it at flat of 4.3 for the next 3 years. I assume that you disagree with that.
I don't really put a whole lot of weight in the Fed's actual projections. You know what I mean? Like I don't think that it doesn't take a PhD to tell people that if you go and look at the S&Ps and then like map them onto the real data, it's more of like an embarrassment for the Fed than anything. Well, what I like to do is look at what their projections are and juxtapose that with what their interest rate path is, and that's where I think the real interesting analysis emerges. And so they basically held their they held the unemployment rate more or less flat, 4.3, like you said, and then they moved their core PCE forecast up to like 2.5, right? And so me, and then they took out 50 basis points of cuts in 2025. My view is that, and so then what we do every quarter when SEP comes out, we have this little equation that we run, and we ask, okay, and we're working off SEP's post 2022. So we're kind of just using this regime, this Fed. So post 2022, if you give me this data and how many cuts should we expect over the next year, basically, is what we're solving for. Um, and our analysis suggested that with this set of inputs for 4.3% unemployment, 2.5% core PCE, you would expect to see the Fed forecast, I think it was between 75 and 95 basis points of cuts in 2025. Instead, they said 50 basis points of cuts. So what that tells us, it's our way of distilling out a reaction function. So this was a hawkish shift in the Fed's reaction function, given that data, given that they think that we're going to have 4.3% unemployment. And so that's what I think the market's keying off of. That is ultimately like, and I think Trump is wrapped up in that, so that's where you see all the, and digging into the SEP, you saw this huge shift in the number of committee members who are now worried about inflation versus growth. I can't remember what the numbers were. I think it was like from one committee member thought that the risks were more towards inflation to 15 in the December SEP. And so there's no real reason when I look at the data to be worried about inflation. And that's another part of the forecast. I don't see the reacceleration um, argument. And unless you throw in the Trump Deus Ex Machina, whatever, like
Yeah.
Trump means, and now inflation is going to reaccelerate. And that's kind of what I felt like the Fed was doing. And so it's a very dangerous path for them to go down, though. I see this as this is a political, it's very much open to a political interpretation. And so,
Yeah, it certainly feels that way, especially when you look at the recent minutes that came out. Kind of validates that. So I do want to get into inflation in a second, but before we do, I do want to just circle back on one thing that you actually tweeted out during that Fed day, I believe, that counterintuitively, despite the hawkish pivot, the hurdle rate towards dovishness, towards additional cuts, actually got lower. Could you explain that?
yeah, I mean, if you get this will go into our little reaction function, framework. But like when you think about now, they've said that inflation is going to go basically, I guess it'd be flat more or less from where we're at today on core PCE through the year, and unemployment is going to tick up just very slightly, and they're still going to cut 50 basis points. That's what their messaging is, at least. So now, if we were to see unemployment go up to, back to the last fall highs, and inflation or inflation start to head down, like let's say we don't end up with that seasonal bounce here at the beginning of the year, I think it opens the door to everyone's going to start wondering what the March SEP will look like. And so it ultimately, in my view, and this is where it all comes down to, this is the point I want to make, is that it's all going to come out to the data at this point in time. We can game out the Fed and all this as much as we want, but you're going to have to, at some point, like I went through that housing analysis and everything, you're going to have to make a call on the real economy and what the data is going to come in at. And that's going to dictate everything. And so if the data comes in, I feel like that's a good bogey that the Fed has set for my view of the economy, to bet on more cuts this year than the consensus expects. Because at this point now, the Fed has set their little line in the sand, 50 basis points with a flat unemployment rate, flat inflation rate, basically. And so if you get a rise in unemployment rate or a cooling of inflation in really even like a little bit, you're going to have a major shift in, I think, inflation cuts. That's why even today we had the PPI come out today, cold, and I mean, it's a PPI. I don't know what the PPI is, not that big of a deal, but already I heard like Steve Leisman on CNBC asking like, will we price more cuts in for the year? It's like we're very sensitive to this data at this point in time. So
Yeah, it doesn't take much for people to go running with it. Yeah, to your point, we got PPI today, came in soft. CPI is coming out tomorrow. Yeah, the Fed thinks that inflation is going to somewhat reaccelerate. You think the opposite. Would love to just dig into the weeds of inflation. I know you focused a lot on shelter inflation and the dynamics there, being that it's one of the largest residual factors of inflation. So, yeah, maybe walk through why you think that's not going to happen.
Yeah, from our last conversation like 7 months ago, you can go back and check that out and say, um, we were we've been banging this drum of sticky shelter inflation for a long time. That was like we've dug deep into it to understand it, and we predicted that the Fed's estimates of shelter inflation would be wrong. They have been wrong, but I do think that it's changing now, and I think we're approaching a point where just to review really quickly, it's like you have new and existing rents, and right now the 80% of the CPI is existing rents. So as long as the existing rental market is still catching up to the new rental market, you have this upward pressure. So the new rental market is what you see in the Zillow index or CoreLogic index. And so once those things converge, that those all those indexes that everyone's been so eager to swap in becomes the actual CPI, shelter inflation. And so I think that convergence point is going to happen somewhere between January and March of this year. That's our research. We look at our preferred gauge of new rents is CoreLogic single family. See, and so they have a little bit of a delay to their data, but CoreLogic single family is making new cycle lows on inflation. So it's in October. I think it printed at 1.7% year over year. It's the lowest it's been in years, and that feeds right into, in our view, how new rents are going to catch down to existing rents. And so that should be a huge tailwind to this disinflation story as we see coming. And it should become evident at least by March of this year, in my view. It might have already started in some ways because shelter inflation stepped down. So that's the biggest, that's 42% of CPI, about a quarter of PCE. Shelter, and this is what you saw Waller talking about, that this is imputed prices and stuff like that. And so I think that there might be a little bit of a debate in the Fed world, but when the rubber meets the road, the Fed's not going to stop from cutting because of imputed prices. And so anyway, so that's vector one of inflation. Vector two would be oil. I don't think that oil is set up to have a huge run. I know that there's some new optimism coming into the market now because of the sanction regime and what could happen with Russian oil and Iranian oil sanctions. I'm open to that as a possibility. It would be a curveball in my forecast, but if you take those sanctions off and just let the market find equilibrium, we're going lower in oil this year, in my opinion. And we had a lot of optimism or pessimism in the futures market at the end of last year. We've run almost all that down. I bet you when we get the update for COT data, we'll be at a optimistic extreme at this point on oil. And so we've seen this run up in oil based on sanctions. We have not seen a corresponding move in crack spreads. So that tells us that fundamentally on a demand side, it's not supported by the market. So I still think that this is a range bound to down year for oil. So that's vector two, and vector three is the labor market. I think the labor market is weakening. I think this Phillips curve view of the world, I think we are set up for job losses in these cyclical areas of the economy to start turning up in subsequent non-farm payroll reports. If you go through those non-farm, I know there's been establishment versus household, but let's just talk about the establishment survey. Percentage of industries showing job growth on a year-over-year basis has fallen below 60%. That's a recessionary number. If you strip out government, healthcare, education jobs, growth is basically flat on establishment survey payrolls. That's also a recessionary level. Uh, so I don't see the inflation pressure coming from the labor market either. So shelter disinflation is going to bite hard in the first part of this year. Oil is not going to exert any pressure on us from CPI, from an inflation perspective. In the labor market is I think cooling despite the last payroll report we got. I think it is cooling, um, and is not going to, at the very least, it's not going to be a source of inflationary pressure. So yeah, that's my view of inflation, and and why I feel pretty confident that we're going to be talking about more cuts than what the market has.
Yeah, I do want to ask, like, my super simple mental model recently for inflation has been, okay, we've seen a lot of disinflation from, especially on the headline of from lower energy prices, from lower goods prices has been, that's, we've actually seen outright deflation on some of the months on goods. At the same time that the services, especially shelter, remain sticky higher. So the way I see it is that, okay, we've had this major disinflationary force in the manufacturing goods sector and everything, but that's starting. We've seen, some early innings of rebounding higher. So now it's like, okay, the onus is on shelter and services to bring us lower continued. So, as I look towards the CPI tomorrow, it's like, okay, if we start to see a rebound in goods and then, maybe just like middling odds of shelter disinflation, does that just cancel each other out and then we remain in this world of sticky inflation? So, I don't see the case for reacceleration for sure when you lay it out as you just did, but does that make the case for substantially sticky inflation?
Well, the big question for the first couple of months of this year is going to be how we get those do insurance numbers come through in a similar way that they did last year, that residual seasonality that everybody's looking at. I've been defining it in a similar way, that it's really going to be a race between shelter disinflation and goods reflation. And I do think that's a valid point. If we saw a real big uptick in car prices, for instance. But my view of that has been like, if you go back now, again, this is where I can see the story that some folks want to tell themselves. Uh, Before this last print of new automobile sales in the United States had been all post-pandemic period below the pre-pandemic 2018 level, let's say, of annual automobile sales. And what I see there is, again, another interest rate sensitive sector of the economy. And so it's hard for me to see a big new goods reflation uh, wave without that first uh, move lower in rates to unlock that kind of buying power from the consumer. We did see a good print on new automobile sales, but again, it goes back to that original point of we had a period of low rates, when we went down to 3.6 on the 10-year for a moment, and that may have helped unlock some of this I'd say credit creation and good cycle that we've been lacking in this post COVID economy. I don't see it really. My bet would be that we get, and I can see this shelter disinflation much clearer in the data, and so I feel much more confident in that. Whereas I just don't see the case for a big move higher in auto prices, let's say, as in this goods segment. So it's a fair possibility that they could cancel each other out. It's also a fair possibility that we could get another boost to insurance rates, which come through here, which would probably be my bigger fear, honestly, in the near term. But my bet is that when the smoke clears by the end of this quarter, it's going to be pretty obvious to everybody that the CPI is trending lower.
Nice. Yeah, well said. Okay, so I want to shift towards the equity situation, which you've had some interesting views that have made the rounds. So your year-end target is, I believe, 6,800 on S&P. The current situation is that valuations are extended, but you make a decent case for maybe not totally excessive valuations. And I just want to frame up that conversation around valuations and around equities with what's been going on with the bond yields, and whether you are a big believer in, okay, higher long bond yields puts pressure on valuations through the discount rate and how that affects equity valuations. So would love to just have you walk through how you're thinking about it right now.
Number one, I do think that higher long bond yields pressure relative values in the equity space. Even taking out the valuation point, but something we watch last time the 10-year got to 5% in October of 2023, if you recall, people like Larry Fink and other folks were coming out saying, watch for pension funds to start rotating into bonds. And, we have a chart just of U.S. pension overall holdings, and they've just crowded into equities over this low interest rate environment. So post 2000, we've seen, I think it's like 75% weight in equities, 25% weight in bonds. But once you get to 5%, you start hearing words like immunizing obligations come up. So there is real competition when yields get that high in this world. So I'm not discounting that. Our work is more about um, is this market in a bubble? Like, can we see beyond the headline PE ratio, which everybody knows is high, and understand what's going on in this market that could be different? It could be justifying this PE ratio when in cycles past this would have been a bubble, but it's not this time. And so that's what we looked at. And the bottom line is, our conclusion is this: the market is not a bubble. You could I think that there's still room, honestly, for multiples to expand modestly. It's not necessary, but I wouldn't be surprised. Like, you always have a range with that is fair value, and I could see multiples expanding further. The real crux of that reasoning is just the composition of this market is totally different than any other version of the S&P 500. So we've had, for instance, 2005, 2006, we saw, I think it was, tech made up 18% of the market. Today, if you take comm services, tech sector, take Amazon out of consumer discretionary, we're close to half the market are in these massive tech companies. And tech is different today than it has been in the past. It's much more mature and higher quality. So the just to boil down a lot of the research on valuations that we've done, if you the biggest path, or clearest path to even more multiple expansion, is margin growth. So if you look at how each segment of the market, cyclical versus non-cyclical growth areas, let's say, when they get when a cyclical area of the market, like an oil refiner, gets an extra percentage point of margins, the market generally moves their multiple lower, because they know that these are the higher margins are unsustainable in a commodity producer and a cyclical producer. So they're constantly adjusting those stocks for that reality. It's a totally different game when you look at, let's say, a consumer staple stock that gains a percentage point of margins, their multiples go up. Tech stock, the same thing. You get an extra percentage point of margins, their multiples go up. That's especially true of these mature, massive, strong balance sheet, high ROIC tech stocks that populate the market today. So what we did, more or less, was we said, okay, and this is on a price to sales basis, really, where you have to look at margins versus multiples. So we said, okay, we're trading at like 3 times price to sales. That's bubble territory if you just put it in like a Z score, like versus history type of analysis. But um, if we swapped in the versus the historic, we did a whole regression on, like, given this margin, what price to sales multiples should we expect? It's like, I don't know, 2.6, 2.7. We're at 3. So even when we adjust historically for where we are, then these record margins, that multiple is still overextended. So everything still looks overvalued. But if we took the actual underlying composition and swapped it in for that same analysis and said, okay, what if we've never seen a market that had this kind of underlying composition, full of mature tech stocks, full of consumer staples? If we swap that into our analysis, what kind of price to sales margin should we expect in a world where we got up to plus 14% profit margins on the S&P 500 with this version? And you could get numbers as high as 3.5 times. So if we were at 3 times sales now, you could get up to 3.5 times in that world. That's what that analysis suggests. So my point is that when you dig into it, also, we have more than 100 stocks in the S&P 500 that have 20% ROIC. Never had that before. Cap weighted basis, ROIC today is at like 23% versus like 12% in the 2006, 2005 timeframe, where we had lower Ps. All these things add up and paint the picture that the market's not stupid. This is not you can't just go by headline PE ratio. I think that's going to kill people. And it's very lazy to take what the market's doing and just assume that everyone who's buying here is dumb and is, like, just lemmings going off the cliff. I think there's something happening in this market that is tripping people up. And when you go back to the 99, 2000 era, it wasn't about what you hear. Every other person who comes on TV now is hand wringing over valuations. They can't get long enough because of valuations, and they tell us about the cautionary tales of 1999 and things like that. That's like a dime a dozen. In 99 and 2000, people were coming on TV and telling you why eyeballs should be valued as you should be valuing stocks as a percentage of eyeballs. I'm not doing that. I'm taking still meat and potato valuation work and just asking a question, can we see this index for what it is, which is way different than anything that we've seen in the S&P 500 historically. And so that's the basis of our call that it's not really an overvalued market. It doesn't mean it can't go down. I think what's going to bring it down, though, are the traditional factors that bring the market down. What brings the market down when it's not bubbled valuation territory, recession, or Fed tightening? Those are the two things you have to be on watch for.
Yeah, I want to ask about this potential. You know, obviously they're not hiking rates yet, but they did pivot towards a hawkish tilt. And something I've been trying to figure out is, okay, what performs in the next 6 months better? Is it growth or value? Is it Nasdaq or Russell? Because you can make the argument that higher rates, long duration stocks, tech stocks, mega cap stocks, they would get hit versus value. Less duration sensitive, that might do better. But then you say, okay, well, if we're going to keep rates elevated, they're all borrowing floating rate in the small caps, so their borrowing costs are going to be higher than what was expected 6 months ago. So, yeah, what do you think is going to do better over the next 6 months?
We've been consistently negative on small caps relative to large caps, and that's been for many years at this point. And I'm not going to try to catch that falling knife of small caps. Now, if we get the absolutely perfect soft landing scenario, where the Fed is hyper responsive to these issues, and this is like to go back to the beginning of the conversation, like what is the journey to neutral? What does the discovery of neutral look like? Well, the nature of that process is going to dictate the path of all these markets, how big of a drawdown we have in the S&P 500, how all these things, like how much the Fed resists or wants to push things for political reasons, maybe. That stuff will dictate the path. I don't want to live that journey, that especially this beginning part of the year. I don't want to live that in the small cap space. Yeah, I mean, maybe things work out and rates, reverse course tomorrow. But I don't see that. I don't think that's going to happen overnight. And so I think there's a lot of pain in this kind of growth scare world that I'm describing for those small cap stocks that had really been betting on lower rates to be more sustainable than they've shown themselves to be. So I'm definitely out on small caps and probably cyclicals as well. I mean, when you think about what's happened with the dollar and what that means to commodity demand and things like that, like again, going back to the oil story, I'm not seeing a sustainable oil rally outside of this like perfect policy mix. I think there's just as likely, let's say, that policy breaks in a bearish direction for oil if we get a resolution of Russia, Ukraine. What does that mean to Russian oil and its reassimilation into the economy and things like that? So I don't really want to be. I don't want to be in small caps or value. I'd rather be in growth and quality, and that's been our position through the bull market.
Okay, so just want to open up the floor to just other asset classes as we finish up here. So I believe you're overweight long bonds. Would love just an update there on how you think about that, and then also just commodities. And you can separate it. Gold as its own thing, or bucket it in there as well.
Yeah, so we it's always these podcasts. You always want to like prove yourself a little bit, like, but we have, here's my problem, honestly, is with the bond trade is there's so many people who come out and they're pounding their chest, higher for longer, blah, blah, blah. These same people were calling for no rate cuts and maybe more hikes just at the beginning of last year, coming into 2024. They're broken clocks in a lot of cases, just as a disclaimer to your audience, in my opinion. So we haven't been consistently bearish or bullish bonds. We've actually been more bearish than bullish, I'd say, over these years. We came into 2024 underweight. We moved to an overweight in the summer when we saw the growth scare materializing and got long bonds. And that was one of the calls I had on your program 7 months ago, is that the 10-year had peaked and so had oil for the year. And so then, like I said, we went from overweight back to underweight the day after the September Fed meeting. And now we've gone back overweight. We did that on December 19th at 4.6 on the 10-year. And I thought 4.6 gives us a good, reasonable entry point for bonds here. And so my view is that if yields keep moving higher, like let's say we do have a hiccup in the CPI data and we even price out all the cuts in 2025, for instance, and we get a 10-year backing up to 5+%, I would probably take and put another slug of money into bonds at that point in time. So to get max overweight, let's say, and that would become a very attractive trade given my views. And so, yeah, I think that the bottom line is that the neutral rate is lower than what is reflected in the SOFR curve, and is lower than what is reflected in the 10-year, and most importantly, the mortgage rate today. And those rates are going to need to come down in order for us to avoid a growth scare. I don't think that it's going to happen fast enough to avoid the growth scare. And when that comes upon us, I think that bonds will get a big bid, cuts will come back into the market. My view is that the 10-year is going to average 4% this year. That was what I said back in early-ish December, and I'm going to stick with that. And so that's where I see it. I think it's a pretty out of consensus view at this point in time, in that by the end of this year, we're going to get to the end of the year and people are going to wonder if there's going to be legitimate discussions, just like there's legitimate discussions today if the terminal rate is like 4.5, like the Fed should be done cutting. Maybe the next move is a hike. There are going to be legitimate discussions about maybe nothing changed in the economy. I'm fading both those things just for the record, but that's where I think we're going on a sentiment basis by the end of this year. That's where we're going. And that's the discovery process of neutral that I see happening. So that's on bonds. Commodities, I'm still bullish gold. I'm very encouraged by gold strength despite this dollar rally. I think that this is all early last year. We saw gold rallying despite a rise in real yields. We've seen that consistently still happening. We're seeing gold rallying despite a dollar strength. I think these are the things you see in powerful gold secular bull markets. And so I expect gold to hit $3,000 an ounce this year. And so that's definitely amongst my favorite commodities. Oil, like I've pretty much given my view on oil. I can see a path to a bullish year if Trump decides to crack down hardcore on Iranian and Russian oil. And maybe there's a backroom deal with the Saudis that kind of gets some more hardcore sanctions there. But I don't want to bet I don't want to bet on that. Maybe energy stocks as a small part of your portfolio as a hedge, because it would really crush the markets. It would crush my view of everything if that were to happen. But that's not something I want to make a cornerstone of my outlook. I think oil is range bound. We're closer to the top of the range right now, and we will have a downward slope to that range as the year goes on.
Nice. Well said, man. Well, look, appreciate you always getting on the show here. You have some very nuanced and original thoughts, so I always appreciate it. All quantitatively backed, empirically based, so it's really appreciated. Where can folks go to hear more about your research and what you do?
Yeah, you can follow me on Twitter at Warren Pies, or you could, if you're interested in becoming a client, we're an institutional research shop. So we don't really cater to retail folks, but if you are an RIA or a hedge fund, or you're running some kind of money, you can put your name into our website at 314research.com, and it's like the number 3 spelled out 14research.com. Put your name in there. We'll send you get some information about you, and then we'll send you some sample research, and then have a discussion if we're a good fit for you.
Love it. Awesome. Thanks for joining us, Warren. That was great.
Hey, thanks for having me, man.
Looking for a blockchain that combines high performance with zero headaches? Scale is your answer. With its advanced parallel processing and modular sharding, Scale delivers gas-free transactions and limitless scalability, perfect for gaming, AI, and consumer-facing dApps. Already a top 10 blockchain on dApp radar, Scale is powering next-gen use cases with over 750 million transactions and counting. Discover the future of Web3 at skale.space/ecosystem and stay up to date with their journey on X at Scale Network.